events. So appreciate you guys joining. Here's the agenda for tonight. So first off, we're going to go through some deals that Old Capital recently completed in Q4, just to give you an idea of sort of what we're seeing in the market in terms of lending, in terms of financing. And then we're going to get into the secondary markets. And so I asked the listing brokers to put together 3 or 4 slides on these markets throughout Texas. And we're going to really dive into those markets. But then also, I basically took your questions that you did when you registered, and I'm going to do sort of a quick fire round of questions at the end of their session. So we're going to give them about 10 minutes to present, and then we're going to do 5 or 10 questions after that with each one of the brokers. And then we're going to go into the virtual networking at about 8 o'clock. So, all right, so let's jump right into here. All right, so here's a snapshot of the team here at Old Capital. There's 11 people here on the team. Most of us are here in Texas, but we have Clay Allen out in Atlanta, and we have Julie Peterson out in California, along with Dave Walls. And so the rest of the team here. And if you want to say hi to Ryan Irvin just joined us at the beginning of the year. So he is here on the call. So if you want to give a shout out to him, that would be great. We will all be in the moderated breakout rooms at 8 o'clock for you to talk with us during those sessions as well. All right. If you haven't connected with us in these different ways, I would say number 1, make sure you're subscribed up to the Old Capital podcast. That's number 1. Number 2, in terms of the conference, we haven't figured out if we're going to do that in person or virtual in 2021, but we will let you know. And then if you have not joined our Facebook group, go on, click the Facebook group. That will allow you to get updates on all the events that we're doing and all the latest happenings at Old Capital. So those are a couple ways to connect with us. And so let's go through a couple deals that we recently closed in the fourth quarter. This was a portfolio deal over in Irving, South Irving, that Jeremy Thomason and his team put together. And it was a Fannie Mae transaction. So we did a 10-year Fannie Mae green loan at 75% on this transaction. The Riata Ranch was a deal that we just completed. It was a Fannie Mae loan assumption plus supplemental for Nick Espinat and Brad Abbott out in Abilene. Julie just completed a Freddie SBL hybrid deal out in Springdale, Arkansas. John Brickson here in Dallas. It was pretty large value add. I think it was like 10 to 15,000 a door in terms of rehab out in Grand Prairie. And we were able to get 75% loan to cost for Raj Gutner, I believe, on that deal. And then we also completed a bank loan. John Brickson completed a bank loan over in East Dallas on a fairly new construction townhome deal. So that was a bank loan, I think, that we closed in less than 30 days right here in Dallas. Ricardo Hinosa closed a good number of deals in Q4, and this was one of them, Centerville Crossing over in Garland, 10-year Fannie Mae loan with 3 years IO. And then also another deal, Freddie Mac SBL over in Oakwood West in Enid, Oklahoma at 75% LTV and 2 years IO. And then also to wrap up, New Orleans was a 68 unit deal that he completed, 10-year Freddie Mac SBL at 80% LTV. So those were just some recent transactions. I think all those deals closed just in the last month. And so we've been busy here at Old Capital, just working on transactions from Fannie, Freddie, Bridge, non-recourse, recourse. So I wanted to next bring on 2 guys from the multifamily group. Number 1 is jon.krebbs and Paul Yazbeck. So if you guys, let me see if you guys could unmute yourself, that would be great. And then that will allow me to bring you up.
Mic check.
All right. There
Perfect. Do you have me, James, as well?
We got Paul and we got John. Yeah. Let me
Perfect.
see if I can pull you up here. Okay. So multifamily group, if maybe Paul, if you want to kick it off and just give us a little background on the group, and then we can jump into some of the markets here.
Definitely. John and I started the company in January 2018. We were a national firm before that, top producers there, worked together since 2015, and we decided to open up our shop. And the picture you see on the right there, we've added a few more folks since then. We have about 15 people, marketing, underwriter, and then like 13 brokers. So we keep growing. We are in Texas, Oklahoma, Arkansas, about to be in New Mexico a little bit more. And then new markets we look at this year, Atlanta and probably Phoenix. So excited to keep growing with our clients, and excited. And Paul and James, thanks for having us on tonight.
Perfect. So I think we've got you up, Paul, first. So we want to dive into Colleen. So maybe give us a little background, a little market dynamics on Colleen, and then jump into maybe give us some deal stories here for some of the deals you recently closed or on the market.
Definitely. Thanks, James. So our firm, myself, we've closed just over 1,900 units there. And the way I got involved with Colleen is I was an Army captain at Fort Hood. And so historically, Fort Hood, or Colleen, is known for being the home of Fort Hood. And because of that, everyone thinks all these apartments have all this military presence and it's hard to get a loan or it's too volatile. And there are a few properties where sometimes they do have a high military concentration, but a lot of apartments, and I've owned down there since 2017, you may have 5 or 10% active duty military. And the agencies only have issues if you're over 40. So most of these properties on here, in fact, all these properties on this list here, none of them have a concentration of military over probably 10, 15%, with the exception of Country Place. That was about 95%. And that owner loved having military in his units. And those were nice 2 bedrooms, all 2 bedrooms, about $1,000 a month in rent. And that was 90s construction. But other than that, all the rest of these properties had very low military concentrations. And the military's helped that market kind of weather economic storms, financial distress, but also it's more diversified. That clean MSA is about 450,000 people. I think our next slide has the number. But we've done 14 deals in Colleen. This is just a smattering of the ones we've done most recently. Unlike other markets, we've never actually closed a deal with a Sumrock or Lifestyles or Think or any other major syndicator. Typically, it's high net worth individuals that either have owned in Colleen and want to add or have owned for a long time. Recently, back in 2017, is when Wayner entered the market for management. Before that, you didn't have a lot of larger management firms in market. And so that might have been part of the reason why some of the syndication groups weren't comfortable going down there. But now they're at about just under 1,000 doors under management in Colleen. They've been doing it for since 2017 in this market. I'd say a deal story, that one, Century Plaza did that in September 2017. That NOI was around 425. And I just sold that in February 2020 on a loan assumption. And the NOI had popped to 925, actually 928. And that was from September 2017 to February 2020. So operators can go in there, reduce expenses, increase income, different value add ideas. And it worked really well for that investor. And that was a hard deal to sell. We were the second brokerage firm to try to market that, sold it for that owner out of Dallas. And then he sold out of it in February 2020. So we've had a lot of clients. The Colony, that one I'll be listing here later in the year for a client. He got that with collections of about 90K. He's now increasing. He's at 115 right now per month in collections. And that'll be a listing that our firm will work on probably late spring, early summer. It's been renamed since. You still find some value add deals. Closed Arbor's Edge for like 26 a door, 50% occupied. That owner's going to go in with a big value add. And it probably do, 5, 10K a door, and he'll probably look to exit that at definitely double his purchase price in probably about 2 years. So untouched, these properties don't trade hands as much as you would see in DFW or San Antonio or other larger markets. So it's a great opportunity to go in there and do those interior renovations, bump rents. We've seen have a lot of clients have success doing that. I've done on some of the properties I owned as well. Basically just doing like the Wayner interior upgrades, and it's worked out well for owners down there.
Paul, can you give us maybe sort of rough, if it looks like most of the stuff is sort of B and C class here, sort of rough pricing right now in this market?
Yeah, when we first, our average our contract price was about 36K a unit. Some that's skewed by some lower value add one. Century traded for in February 2020 for like 59 a door. That's Century Plaza deal, and that was built in the mid 60s. C-class property, but I would say B amenities. Cap rates when we first started transaction in market in 2017 were closer to an 8 for C-class, and I would say now they're probably dropped more to like a 6.5, 6.25, and then the value adds will go much lower than that if there's a good obvious upside on them.
Okay, good. I guess that was sort of the map of Killeen, and remind people sort of where Killeen sits and sort of the size of it again.
Yeah, so we're Killeen MSA, which includes Temple, Belton, Copperas Cove, about 460,000 folks. So it's fairly large. Large geographic area. Fort Hood's the largest military base in the entire world. So if you're coming up I-35 from Austin, it's a little over an hour, and then you head west a little bit on 14. So if you're coming from Temple, it's about a 25-minute drive from Temple. Waco to Killeen is about an hour and a half. And okay. So it's right off 35, 10 miles or so. Perfect. To the west.
Anything else on Killeen before we jump over to San Antonio?
No, I would say it's a market where I think it's also benefiting from Austin's growth. You have people that will live in Killeen and commute down to Round Rock for work because of the housing affordability. There's been no deliveries of new product, which has helped allow owners to boost rents, as the first bullet showing there. And we're always active in that market. If it's a market you want to learn more about, we're happy to talk more. We only have that one deal right now, Liberty Landing, available, and we'll probably have another listing of that Colony property here in probably 3-4 months.
So we like to jokingly refer to you guys as the kings of Killeen. So appreciate you kicking it off here tonight. And let's go over to John. Are you there? jon.krebbs. Let's pull up. So I wouldn't necessarily usually we think of secondary markets as, maybe an hour and a half, 2 hours outside of big metros like Dallas or Houston. Or even Austin. And, Killeen's probably an hour or so hour and a half north of Austin. But I wanted to highlight San Antonio because you guys have done a lot of transactions there. So John, maybe I'll pass it over to you and maybe talk through a couple of these deals that you guys have closed recently in the last year and maybe are on the market.
Yeah, thanks, James. These are all deals that we did just in 2020. A couple of them were marketed unsuccessfully, and then we had one that went under contract before COVID and then fell out and had to come back to the market with. A lot of these deals have been owned by the same person for 10 or 15 or 20 years. We got into the market down there in 2018 and just kind of saw it as being an underserved, underbrokered market. And yeah, it's been really good for investors. We haven't seen a lot of, like Paul mentioned, some of these deals come in full cycle and now taking some investors out. Right now we're doing that with a property called Glenwood that we sold in 2019, and now it's back on the market. So some of these are first generation deals, our firm's first time to sell them. It'll be interesting to see. I've been paying close attention to the Seven Pines property. The buyers have been really marketing the upgrades they're doing there, and they look really nice. Excited to see that property was owned for 21 years before it changed hands back in October.
John, can you maybe give people an idea sort of on, if you're looking at a map of San Antonio, sort of where these deals sit and sort of how maybe Northwest San Antonio versus Northeast or Southeast? Can you give people an idea of sort of demand drivers in this market?
Yeah, historically, the southern part of San Antonio has been kind of redlined by investors, and they didn't want to go down there. We actually brought in a big owner operator out of Dallas that bought Utopia Place. And then I mentioned Seven Pines. Yeah, as you get closer up to the northwest is where the University of Texas at San Antonio is. And the properties get a little bit nicer. Over on that northeast side, they're a little bit older, there's a lot of C-class property over there, but it's good areas. We always get a lot of activity from investors over there. San Antonio, it's a big city. It's got, the land size is very large. It's got, well over 1 million people. And there's quite a bit of product there. I think, more than people might realize.
All right. I'll flip over to this next slide. Maybe this is what I was alluding to. Maybe just touch on maybe these nodes that you have highlighted here on your slide.
Yeah, the last one that we sold was that Stone Oak Place up in the northwest side. And it's a great market, but this property just happened to be, owned by some guys who'd had it for a long time and weren't really proactive about, managing during the COVID pandemic. So it was actually in forbearance, and their debt service coverage had dipped, below 1. They weren't able to meet debt service. So we brought in an investor to assume that loan, and, they were really happy to get the deal at a good basis, and the seller, frankly, was happy to get out of it. But that market up there is really strong. You see 18% rent growth, and that's in the last 5 years. I think our information from Yardies was a little bit stale. It's probably even up more like 21% since July 14, and that's significant when you look at how that affects the cap rate. Over on the west side, we did a deal over there that was in very poor condition. It's actually not on this map. This was not on that map? No, it's not on there. It's back in 2018, but it was rough, and now the owner's coming in there and fixing it up. You can see that there's not a lot of occupancy. Now this is for, I'm sorry, there's not a lot of supply growth, up in that northwest side, and most of the supply is coming from A class, and that's where we saw some softness in the market. But in B and C, there really hasn't been. It had a little dip, but the rent growth has been pretty flat. You look at nationally, rent growth has been down over the last year, below 0. But there's even been some positive rent growth in, B and C class in San Antonio.
Okay. Let me see if I got. So maybe talk on deals on the market real quick here in San Antonio, John.
Yeah. So, Executive's a little bit smaller deal. It's, low 60s a door is what we're whispering on that. It needs some, lipstick. I mean, the exterior is tired. We've baked that into the pricing though. Glenwood is a really clean deal. Very nice. It's kind of set back in a neighborhood. That's the one I mentioned that we just sold back in 2019. Mission Villas has been hit a little bit harder by COVID-19, but it's again another basis play where you could pick it up in the low 60s a unit, and it's 176 units. Have some scale down there. So if you want to talk with us about these deals, feel free to reach out.
All right, perfect. So I'm going to hit you guys with this is like the rapid fire round, and see if you guys maybe can take 30 seconds to a minute and just hit these real quick. All right. So Daniel Kramer asked, how have secondary markets changed after COVID? Paul, you want to take that one?
Sure. I would say in Killeen, we've seen a few instances where people are doing the CDC order to prevent eviction, but I would say by and large, people are maintaining their collections. The clients I have are still running over, 90 to 95% occupancy, and maybe just have a few tenants that are taking advantage of COVID. But overall, I would say not a huge impact. The Liberty Landing deal we did have listed they have dropped down into like the low 80s occupancy. They've been hit a little bit, but they're smaller and they split a manager that's not always on site there. So I think that's more of a management issue than the actual market or COVID.
Okay. Let's see. Matt Stacy asks, why do institutional investors typically not invest in secondary markets? Jon.krebbs?
I think there are institutional investors that do invest in secondary markets, but primarily they're looking for, less risk, and so they're willing to take less return by going into, a market like even, I've heard, back 10, 12 years ago that Dallas, wasn't even really considered a primary market. It was mostly the coastal, gateway cities like New York and Los Angeles, Chicago, San Francisco. I think more institutional capital is looking certainly at Dallas Fort Worth and now, San Antonio. We just listed a deal in Waco. There's certainly some, institutional groups there. So, while there may not be a lot of institutional investors in Killeen, I think it provides an opportunity for investors that are, might be on this call to go in and take advantage of some opportunities.
Okay, perfect. Salvador asks, what is the best way to access secondary market deals? Paul?
I would say just talk with, all the guys on this call all work secondary markets throughout Texas. So I'd get in touch with any of the brokers on this call and get on their lists. And some of these deals are listed. We tend to try to list off secondary market deals more because there is a smaller buyer pool than a primary market, but there's definitely off-market opportunities as well. So I would just get in touch with the broker, any of us, and probably help you out.
Perfect. All right. Jared asks, okay, how can syndicators better approach brokers to add value to them in order to see their pocket listings? So maybe go back to Paul on that one. So let's say they know you and 100 people reach out to you from this call, but then how do they stand out? I guess is a better question.
I think, for me and maybe some other guys as well is, if it's your first deal or it's your third deal, just say what it is. Don't puff at what your experience is or what your experience isn't. Just be upfront and honest. And then when we send you a deal, I would say, if you're going to try to give us feedback on it. I didn't like it because of this. And we're trying to reach back out. I was just touring someone in Albuquerque and they toured it at last minute. I'm flown in, got to go out of my way to get the manager to agree to a tour. And then they just kind of ghost you afterwards. So that's not someone I want to show more off-market deals to, because I went out of my way to get you a tour last minute. And then you didn't like it, but instead of just saying I didn't like it because there's not as much value as you wanted or some other reason, you just kind of go silent. I'm probably not going to try to show you more deals. We just want feedback, I would say, on off-market listings. And if you have a plan for, if you have a reputable lender, other ways you can be vetted, I think that always helps stand out. Here's who I'm working with on the lending side. Here's who I'm working with. I'll probably look at these 1 or 2 management companies, anything that can make you more credible, because we know the people you're working with. It always helps.
So associated credibility is what you're saying. Always helps.
Correct.
So we'll leave this one for the end, maybe. Let's see. So George asks, John, what are upcoming markets that haven't seen the spike in pricing yet, but have the fundamentals for it? George asks.
Yeah, that's a great question, George. I think, and I've seen you looking out there, Oklahoma City is one market where I sold a property, Springs of Moore. It's a good sub-market, good, bedroom community of Moore just outside of Oklahoma City, and sold it for $36,000 a unit, and it had individual HVAC and, it had some stuff going for it that owner's definitely going to be able to make money with that property. So, it's kind of starting to get pricey in San Antonio. Maybe a year or two ago, I would have said that one. I still think it is, cheaper than, Dallas and Houston. So I think there's opportunities there. And then, Paul mentioned Albuquerque. He's got, another property. We've got a couple properties we're selling there. I mentioned the listing in Waco. I think they're all, it's deal specific, but there are some, low basis deals out there for folks that are looking to add value and maybe take a little bit more risk going out to some of the secondary markets.
Yeah, we did a low basis deal in Little Rock last summer, and obviously clean. We traded below 30 a door last year as well.
All right, let's hit these last two. I don't know how to say this person's first name, but what metrics are not on most people's radar when selecting a secondary market? Paul?
I would say just from the debt side, James, you can, maybe, educate people a little bit about how, like Oklahoma City, I know Matt's can talk about Amarillo. Some of these markets are pre-review, so that may not be on people's radar, that, debt service leverage may be a little bit different in some of these markets. We look at a lot more bridge and bank loans, especially if on these deals that are, on the margin for occupancy. That's one thing that comes to mind.
Yeah, I think what on that point, I think on the lending side, you definitely have to. It's market by market, and then it is also sort of what size, right? So Freddie Mac, SBL is going to go up to a certain amount, but they're going to look at deals a little different than Fannie. So you're going to have to, even though you definitely need a mortgage broker in Dallas, you definitely need one in secondary markets, because I think a lot of times it can change very quickly. And so you have to know sort of the appetite of Fannie and Freddie in that market. And we can sort of give you that, a spreadsheet between the two on almost every deal.
That's a great point, James. You did a debt quote for us in Albuquerque recently. That came back at 80% LTV, which blew my mind. It was higher than some of the markets like Killeen or San Angelo, and you guys have warned us about Tulsa being lower as well. So I think Albuquerque seems more risky to me, but not to the agencies.
Yeah, I mean, sometimes it's not just a function of the industry, but sometimes it is how much exposure they have in that industry. And then if they have a large concentration of multifamily in that market, then they might just turn down that market, even though that market might be fine, right? But the agency debt that's available in that market just might not be there. So we'll wrap up with this one. Marco asks, how easy or hard is it to get a good property management company in the smaller markets? And Paul, you touched on this, but maybe talk about property management in these smaller markets.
I think, if you can show a company that you're going to grow, or, if I talk to, like, Wayner, for example, wasn't in Killeen in 2017, and now they have 1,000 doors. Wayner is not in Lubbock. I have a client that works with them, and they're going to be in Lubbock starting in April on 300 doors. So they're entering new markets. They weren't in Little Rock until last summer. Now they're in Little Rock. So if you have a company you like, and you're going to be a growing client, you can probably get a bigger management firm in there. Because you're right, a lot of these smaller markets do have smaller management firms. But I think if you reach out to some of these larger ones, they are looking to grow in these secondary markets, because a lot of it is mom and pop or self-management right now. But you can get a larger firm into these secondary markets for sure. I've done it in 3, not that long period of time.
That is perfect. Thank you guys for jumping on. If you guys can hang out for a little bit, we'll throw you in a breakout room at 8 o'clock when we do, and maybe answer some questions in there. That would be great. But I appreciate you guys coming on tonight.
Yeah, they did a great job. James,
thanks for having us
here a little bit.
Yep. So let's see. We got Bart and Matt. If you guys could unmute yourself and maybe just do a mic check, and we'll get you guys up here next.
James, can you hear me?
Hear me, James?
Yep, I got one.
I'm here. Can you hear me?
Yeah, I can hear you. There you go, Matt. I wanted to see you on the screen. I got Matt, and then let's see. Is Bart on?
Bart's here.
There you go. All right, I got you. All right, so I'm gonna. Whoever wants to kick it off. I pulled up this slide here on the transactions you guys have done recently, and I'll let you guys take it away. Maybe do about 10 minutes on your presentation, and then we'll get into the Q&A.
Yeah, so this is Bart. James, first of all, thanks for having us. You guys have just done a tremendous job with your debt shop over there. We were fortunate enough to closed a deal with you guys as recently as Friday, a deal in Tyler, and it was not an easy deal to get done. And for all of you on the call, you know, you guys are coming to the right place for debt solutions. These guys are miracle workers sometimes, and a great group to partner with, especially when it comes to the secondary markets. There's probably not a market on here that they haven't closed a deal, you know, in the last 12 months in. So thank you for having us. So I'm with NKF in Dallas. We're a global real estate firm. Used to be ARA till we were purchased a couple of years ago. We're a part of a bigger partnership in Dallas of 7 brokers. Matt and I focus exclusively on the Texas secondary markets, as well as New Mexico. It's all I've done for the past 10 years. We've been very fortunate to be extremely active. You know, it's amazing to me just in the last decade, the evolution of the Texas secondary markets, the amount of transaction volume we're seeing, the amount of investor interest we're seeing, and just, you know, how these markets have matured in the last 10 years really is nothing short of amazing. And so, you know, I think there are a lot of reasons why people want to invest in the secondary markets, and it's evidenced by, you know, the fundamentals and the strength and the transaction volume we're seeing really in every single one of these markets. You know, some years you might have a hot market like, you know, Killeen. The next year it might be Midland and Odessa that's seeing a ton of volume. The next year it might be Longview and Tyler. But, you know, with any of these markets, you're going to see transaction volume. And I think one of the fears that investors had that really I don't think is warranted anymore is, okay, what if I buy this deal? The fundamentals of the market look good. The deal looks good. What's my exit? You know, who's going to buy this? And, you know, the reality is although you don't have quite the buyer pool that you do in Dallas, Fort Worth, you know, Houston, Austin, it's significant enough that almost in every listing we have, you know, there's a market for that deal. And it's not just 1 or 2 buyers, you know, it's 10 buyers, it's 20 buyers. And at the same time, though, what's great is, you know, the institutions, you know, the big guys who really bid down deals have deep pockets. You know, although sometimes they will invest in these markets, it leaves the opportunities for, you know, some of the people starting out or just building their portfolio of deals to be able to be competitive in assets, and is really a great place to start off your quest to building a multifamily portfolio, because you can buy deals and the metrics and fundamentals are really good. So just looking at this slide here, you know, we're active in all of these markets. You know, in Midland and Odessa, just in 2019, 12 months, it's been 30 million. But what we've seen drop off in the oil and gas market, like Midland and Odessa, you know, we've seen an uptick on, you know, Tyler and Longview. You know, even during COVID, the heart of COVID, we sold a couple Longview deals, couple Tyler deals. And the reality is, and this kind of goes back to that other question, you know, the pandemic, I think, has been treated a little different. They didn't have the evidence of cases in some of these smaller markets. And so, you know, it didn't see the volatility and maybe some of the rent or occupancy decline that you saw in some of the primary markets. So anyways, we work primarily in North Texas, although we do cover the whole state. And that's about it.
All right, so maybe we're going to deep dive a little bit here on East Texas. So I pulled up the slide on Tyler and Longview. So maybe give us your snapshot of those 2 markets. Yeah,
so I really like both of these markets for a lot of reasons. It's hard to highlight all the reasons. I mean, one of the best things about it is you can jump in your car and you can be from downtown Dallas to downtown Tyler in almost about the same time it takes you to drive from Dallas to Fort Worth during rush hour. You know, Tyler, Texas, on the I-20 corridor, it's a very white-collar town, very diversified economic drivers, a ton of medical in both Tyler and Longview. A lot of people retire out east. You know, they have lake houses, they golf, what have you. And so, you know, it's just a good, strong market that has great occupancy, 95%. I mean, that's better than most of the primary markets in Texas, much less the country. Good, solid rent growth. Unemployment is, you know, 6.4%, which is high. A lot of that's driven by COVID, but I think what you'll see in a lot of these markets that we're talking about tonight, you know, unemployment rate is a lot lower than that of the primary markets. So, you know, there's over 12,000 units in Tyler, and, you know, I bet you see 10 deals a year that trade in that market. And so it's highly sought after. It's on a lot of people's radar screens because of the proximity to Dallas. You can, you know, go check out your property, do what you need to do, and be back in DFW, you know, before dinner time. Makes that highly appealing. You know, Longview, very similar, a little bit bigger MSA, but less apartments, surprisingly enough. Longview used to have a lot more dependency on oil and gas, specifically the Haynesville Shale that sits east of Longview. Coincidentally, Jerry Jones just made a $1 billion+ play in buying up a bunch of acreage out there. He thinks it's the next big shale play. But since the oil declines in 2015, that market's really diversified itself. You have several universities. You've got, again, a lot of medical there. And that's reflected in strong occupancy, strong rent growth. And, you know, I think the multifamily group touched on this. You know, one of the really exciting things about any secondary market in Texas, specifically Tyler Longview, is that, you know, the value add programs that you've seen played out, you know, 2 and 3 times already on a deal in Dallas, they haven't been touched in Tyler Longview and, you know, these other Texas secondary markets. So owners can come in and take a classic unit that, you know, is a nice unit, but hasn't had, you know, the quote unquote Wayner upgrade or any upgrade. And we've seen time and time again that owner operators have been able to implement a value add, do it pretty inexpensively, and see, you know, rent increases that are on par with that of the major markets. And it's really pushed NOIs, it's pushed values, and owners have been doing extremely well in these markets. And East Texas is no different.
Bart, I'll jump in there. One of the deals we sold last year in Tyler had Harvest Gold toilet bowls. So, you know, that just goes to show that it was built that way and they thought that looked good back then, but it doesn't look good now. And that was a huge value add. The other thing I think is worth pointing out on these is, you know, you may not think that Apple's tracking you, but all y'all with Apple smartphones, this is their mobility data on the bottom there. And you can see these markets perform tremendously well. This is them tracking the activity of people moving about on a day-to-day basis. And in Smith County and both Grade County, it shot up. I mean, people started living their lives and acting like this global pandemic didn't even happen. And we saw it in the marketplace when we were selling deals. Perfect. I guess, Matt, we'll jump over to you and touch on Amarillo then. Sure. Amarillo by Morning. Great George Strait song. But no, very, very good market. That MSA population is actually over 300,000 today with the new census that's going to come out. So Amarillo is a very large market, and there's about 15,000 units there. The thing that you'll see in all these secondary markets, and Amarillo's no exception, is there's very little supply in the market. And so the Class A product that has been built, that's you know, may be 10 years old now, is still getting $300-400 more in rent, maybe $1,000 rent, whereas the B and C product is $600. So there is a huge gap between the Class A space and the B and C space. And so the value add program is working, and investors are able to capitalize on that. And that's why you'll see good rent growth in these markets and opportunities to employ this. And Amarillo has been a great performer during the global pandemic. It's a very diversified market. I call it a recession resilient type market. The unemployment rate is only 4.9%, when I think Texas is closer to 8, and US is around 6. So it just goes to show a market like Amarillo has performed really, really well. And that's reflected in the mobility data as well that we pulled from Apple, just seeing how many people are getting out and driving around and acting like the world is not coming to an end. In markets like these, you see people tend to just live their lives, where you go down the street in a major market like Dallas today, and people won't look at you. They're afraid they'll catch something. So that's just the world we live in. And so with that, we do have a deal out there. James, thanks for showing that, is the Enclave. It's 225 doors, 1972 construction, 946 average square foot units. When they bought this, there was a lot of distress on this property, and they've since put about $2 million into it. They implemented a value add program, kind of 2 tiers, a full upgrade and a partial upgrade. And the full upgrade is getting as much as $145 on a turn, which you may not think that would happen in a place like Amarillo, but it is. And they've demonstrated this. And so this one's out on the market right now. I'll be out there on Friday doing tours. It's right off 40. You've probably driven by it if you've ever driven through Amarillo. It's called the Enclave. And if you want to go tour it, let us know.
Perfect. All right. So I think, Paul, did you have a question real quick that you want to jump on?
Never quick, James. Never quick. Good evening to everybody. Again, I'm Paul Peoples. Thanks for joining us. The things that I want to maybe bring out that maybe we haven't answered for you is really the why. Why the secondary markets? Why that's important? And so I'm going to kind of ask James that question. Why is it important now? I mean, really, what's going on in the economy that I think that everybody's aware of? But why is secondary market so important? And again, it doesn't make a difference if tonight we're focusing on Texas. This could be Wisconsin, this could be Pennsylvania, this could be Ohio. So, but what's the important right now of the secondary markets, James?
Yeah, I mean, I think it's a couple of things that have happened. One, I would start with just sort of yields in general, in terms of interest rates on your savings account going down. Cap rates going down everywhere. And then a culmination of that plus sort of what COVID has done for technology, right? And what we're able to do and where people can work, and whether they're working from home or working from the office 2 days a week. People have decided that they're okay spacing out a little bit in terms of they don't need to be on top of each other. And so we would have usually been 300 or 400 deep in a big room right now, but we're not. And so the technology has allowed us to, everyone can sort of zoom in from wherever they are. And that has allowed people to work from anywhere, but also live anywhere. And so that has culminated in investors search for yield, where people want to live. And then also, I had one more thing, but I think those were the 2 big things for me in terms of search for yield and work from home.
Yeah, I certainly do agree with that. Is that, we've seen a change of where people can work, just like James had said. If you were living up in San Francisco or the Bay Area, now you can live any place you want because you're not necessarily tied to a desk. And so if you want to move to Lawton, Oklahoma and be close to your parents and work out of your house with great Wi-Fi and T1 lines or whatever, however you get your internet, you can certainly do that. One of the things that I do want to bring to, we talked a little bit about Tyler, and I saw that Lane Bean was in our conversation. Bart had made a disclosure to everybody that we closed a loan for Lane and his crew out in Tyler, Texas, just last week. And Lane is a good operator. If we can pull Lane on here, if that's possible. Lane, if you can turn your camera on or your microphone on. You live in Dallas, but why would you explore out in Tyler? Why would you make a position in Tyler?
I think you asked me, Paul, can you ask that again? You said, why do we go to Tyler?
Yeah. Why did you make a position in Tyler? Why were you exploring Tyler? Again, Tyler is about 90 minutes east of Dallas. It's a nice community. It's like hometown USA, but it's not a central business district of like Philadelphia or Austin or some of these larger towns. Why would you go out into that secondary or tertiary market?
Yeah, and it's exactly what has already been said. The yield was better, the basis was better, and I felt like we were able to get a good value for the property that we acquired. There's still, for the value that we were able to get, we were able to still increase our value add strategy percentage the same. So I thought that was why, and it's been iterated several times. The value in the smaller markets still exist.
What due diligence did you do on a small town that you probably wouldn't have had to have done in a larger town?
Right. We really went into the market. We studied exactly what our tenant base was going to be, what type of absorbency was going to be there, what was the supply and demand of the housing market in that area, and what was the demographics of the particular submarket that we were investing in. So I think we did a little bit more due diligence in Tyler than we would have done in the primary markets, because the primary markets, there's a lot of assumptions because we're so familiar with them. And I wasn't as familiar with the Tyler market. So we studied the market stronger.
So I think that's an additional thing that you have to look at is what is your employment base in some of these small markets. If you take a look at an area close to the northern part of Arkansas, Siloam Springs up that way, we did a loan up there a number of years ago, and we had a problem because we had a concentration of employment, which means we had too many people in the town that worked for the same employer. So think of Northwest Arkansas. What's the big employer in Northwest Arkansas?
Walmart.
Well, it would be Walmart, wouldn't it? But it wasn't. It was Tyson's Chicken. So chicken rendering plants that takes a big chicken and makes it into pieces. So that's something you have to figure out too, is what's your concentration level of students? What's your concentration level of one employer? What happens if that employer goes out of business? What's your concentration level like in Killeen? Just like Paul had mentioned, how much military are you exposed to? So if there is a base that's going to be closed, what kind of an impact possibly in the future is that going to have on your property? So there's additional due diligence that you have to do. And also, last thing I want to maybe bring up is these guys that we have on are the best of the best in the secondary and tertiary markets. If you walk into an office like Marcus and Millichap, you're not going to not all those guys are experts in secondary, tertiary markets. If you walk into Matt's office over in Newmark and with Bart, you'll find that out of 10 guys, there's only 2 guys, and you have those on tonight, Bart and Matt. You have to find those guys, whether you're looking for properties in Philadelphia or in Florida or in Nevada. These are specialists. These are specialists in the marketplace itself. So they're not going to be focused on the central business district of Dallas or Austin or San Antonio. They're typically focused on these secondary and tertiary markets. They're the ones making the calls to these places that are 90 minutes away or 100, 150 miles away from the central business district. So if you're in other areas that you're looking for, find guys just like Matt and Bart and Paul and the rest of the guys ask them what their specialty is. So without any further ado, James, I'm going to throw it back to you.
Thank you, Paul. The third leg of the stool that I forgot was affordability. And, a lot of people come to Texas for affordability out of these high cost areas. And, the rent in Dallas has continually gone up. The rent in Austin continues to go up, but secondary markets, I pulled up the slide here. The average rent in these markets in Amarillo is $761, $816, $950, right? So all under $1,000 average rent in these markets. So that last piece I would say is affordability. So Matt and Bart, we're going to hit you with a couple of quick fire questions here, and let's see if we can knock these out. So Greg asked, what do you think the cap rate spread between secondary and primary markets is?
So I would say in general, you're looking at, and it depends on the market. Like you could go, if you've got the stomach for some potential volatility in the oil and gas markets like Midland and Odessa, you can buy true 7 caps today. Which, that's 300 basis points over, what we're seeing in Dallas. And, I was talking to some guys in Austin. They hadn't seen anything without a 3 handle in front of it in over 18 months. So, but that being said, depending on the market, on average, maybe 50 to 75 basis points. That deal that we're selling in Amarillo, out of the gate, true cap rate is a 5.25 with upside. I think if you plop that deal down in the mid cities, it's likely a low 4. So, at a minimum 50 basis points, and as high as 300 if you're looking in, some of the counter-cyclical markets.
And then Bart, let me ask you a question real quick here too. Greg Shockey's in the oil and gas business. How about the guys that bought out in Midland, Odessa 3 years ago when gas was at $110 a barrel? How are they doing today with the employment? How are things going out in the Midland, Odessa oil patch?
Well, the nice thing for those guys is they put so much money in their pockets over the last 3 years. If they were smart with it, they're doing just fine. But if you bought at the peak, who anticipated COVID, right? Who anticipated oil prices going negative? We have an administration change and there could be some impacts there. So, the future certainly is unknown, but like any market, if you buy a good piece of real estate and you do it wisely with good debt, good partners, a good operating plan, you may not hit a home run right now, but they're doing okay.
All right. Let me jump over to the next question. Aaron Kelso asks, pros and cons, maybe hit biggest pro, biggest con, I guess, of investing in a secondary market. Matt.
Yeah, well, I think from the pro side, it's frankly a better risk-adjusted return from what I see. Strategy seems to be more, you can do it. Where a lot of guys go in and they say, hey, I'm going to raise rent, to make a deal work in Dallas, got to raise rents $300. Well, you don't have to do that in these type of markets. So you can hit your business plan, you can achieve your goals. And so I think the pros are very good risk-adjusted returns. The con side would, and I think we've talked about this a little bit before, but it's just finding the right management company. Management companies is one of the biggest issues in a lot of these markets. So if you're talking to us, make sure to ask, any of the brokers, what's a good management company that I should be looking at this property with? Because I think that can make a huge difference.
Great point.
Okay, I think we hit the stats. I guess David asked, what are market conditions, short run versus long run? Bart, maybe I'll take 12-month forecast versus 5-year forecast for some of these secondary markets.
Well, I mean, I think just in general, investing in the great state of Texas makes sense. There's employment growth, job growth, there's a diversification of industry, there's net immigration. I mean, people are moving here. So short-term and long-term, I like investing in Texas, very business friendly. In the next 12 months, the hope is obviously COVID gets put in the rear view mirror and everybody can look forward to, a resumption back to normal. I think a new normal may be different. I read the other day that the Fed thinks that they're going to keep rates, extremely low at or near zero for the next couple years. So, as long as interest rates remain low and there's a low cost of capital, I think you're going to continue to see real good growth in multifamily specifically. But then I think you'll still see, a good amount of transaction volume. So I think it's probably better in the long run than short run because we still have, a little bit of a roadblock in front of us getting through this COVID thing, but at the end of the day, I think it's still very, very good.
That's perfect. Yasutomo asks, which secondary market in Texas is best to invest in for a first-time investor?
Yeah, that's a tough one. I would say any of them are going to be a great option. Just like Bart said, invest in the great state of Texas makes sense. The meta narrative on Texas applies to these secondary markets. However, we'd probably be biased to the ones that are closest to Dallas. If you're a first timer, just getting out to those markets is a little bit easier that way. You can go to an Amarillo and that can make a ton of sense. It's just a 45-minute plane ride on Southwest. It's not really that big of a deal. But some of these markets can be a little bit tougher if you're going to go, to Pecos, Texas. It's really hard to get to. There's not an airport nearby, but there's still deals to be done there, and there's still opportunity if you can see it. So I think just making sure it's a market you can get in and out of as a first timer, I think that makes the most sense.
Perfect. Brandon asked, while the Dallas population has increased dramatically, how has that translated to secondary markets?
Well, you've seen growth throughout most all Texas secondary markets, albeit maybe not quite as fast as what you've seen in Dallas, but you also see the urban sprawl. Waxahachie, Granbury, Midlothian, Forney, Terrell, even Sherman, Denison. Back in the day, these were secondary and tertiary markets, and with the growth of DFW, it's almost a part of the Metroplex. So, secondary markets are still seeing population growth. One of the, I guess, maybe to piggyback on why invest in secondary markets, take Midland and Odessa out of it, but you don't have the volatility. You don't have quite the ups, but certainly not the downs that we might see in primary markets. And it's an old cliche, slow and steady wins the race. Well, I'd argue it's not slow in these markets. It's still pretty speedy, but you don't see that up and down. And so, a lot of that is because, you don't see people just abandoning jobs in the city and moving to other states, quite as much in some of these towns. I mean, they're rooted there, their families are there. You don't have the transient type of population that you might see in some of the major metroplexes. So although we've seen very nice population increases through most of these markets, it's going to be slower and steadier. But part of the real benefit, and we talked about this earlier, is the threat of new supply hitting a market or a submarket that can just absolutely kill a submarket, which we've seen time and time again. And in certain pockets in Dallas, that just doesn't happen out there.
In any of the markets that you touched on today, is there any new supply or no?
Well, yeah. I mean, when I say new supply, it may be 1-2 deals a year, 300-600 units, maybe 900, but it's not the thousands and thousands of units that you might see, in different submarkets and some of the major metroplexes. So you still have supply because the rents are good and there's growth and there's reasons to develop, but you don't see, 10 deals being built overnight within a mile of one another.
Right. All right. Kapil asked, how do you expect offer terms in terms of hard money, due diligence? Are they different in 2021, or what do you expect? Let's say on your deals, what are you expecting people to put together for your secondary market listings?
Yeah, I would just say generally terms are a little bit lighter, especially on the time period, just because it takes longer to get out there. But frankly, what we've seen, and Bart, you can attest to this, we've seen terms that are very much in line with the primary markets. I mean, it's not a whole lot different. When you have the same buyer and seller pool that's operating in these other markets, working in these secondary markets, it's not uncommon to see hard money immediately upon contract execution. Earnest money, being 1% to 2% of the deal. A due diligence time frame that may not be 60 days, maybe 45 days when it's all said and done. So generally speaking, the terms are a little looser. However, we haven't really seen that on the deals that we've been transacting on.
All right. And this is sort of like turning the typical question around is, what qualities should an investor look for in a broker that they are considering using on a deal? So it's sort of a turnaround on the typical question of what the investor should do. What should they look for in a broker, which I thought was pretty interesting. So maybe Bart, if you want to take that one.
Yeah, sure. So, I mean, first and foremost, honesty, integrity. You want to be working with somebody that you can trust, right? You need somebody who's competent, somebody who, you know, is, no offense, we all have to start somewhere, but, you know, it's good if they have a couple skins on the wall and have been around and truly do understand the marketplace and the market. So, you know, I think trust, honesty, competency, and then probably lastly, just somebody who is gonna pay you attention. You know, look, we're all busy and it's a great market to be working in, and we get pulled in a million different directions. But, you know, I try, I know Matt tries, and I'm sure the other brokers on this call. I mean, there's a reason why, you know, we're among the more successful brokers, is because, you know, we really try to pay attention to each and every person. And if we don't, you're not going to hurt my feelings if you say, hey, you know, Bart, I left you a voicemail 2 days ago. I haven't heard back from you. I would feel bad if that were the case. So don't hesitate to call again and say, hey, I'm following up on this.
All right. That's perfect. Well, I appreciate you guys jumping on tonight. And if you guys can hang out for a little bit, we'll do a little virtual networking right after this last group.
A lot of people want to talk to you guys.
Yep, we'll hang.
All right, perfect. So Sean, Scott, Matt.Aslan, if you guys want to unmute and put your video on, that would be great. And we will move over to you guys. I see Matt. Is Sean on yet?
Hey, James.
All right.
I am here.
Okay, there you go. Perfect. All right, so we will.
Hey,
yeah.
Check. Can you hear me?
Yeah, you're good to go, Matt. So I'll swing it over to you guys and let you take it away. So we'll maybe start on your slides and then we'll hit the quick fire questions.
Okay, sounds good. Appreciate it. Yeah. So first up, you know, just some deal history for our team. You know, I would say before we really formally had a secondary markets group, you know, still had a number of secondary markets transactions that the Fluell and Hoover team here at Marcus and Millichap has done. But as you can see here, you know, that number has really increased significantly since Matt, myself, and we've got a few other guys on the team have really started, you know, focusing on these markets over the last several years. You know, so amongst our group of, I guess, 12 brokers overall at M&M, you know, we've got, 6 of us now, Matt, that are focused, you know, exclusively on secondary markets. And so that's, you know, really helping us to increase the volume and ultimately, you know, hopefully helping investors to realize a lot of opportunities that they otherwise wouldn't. You know, I think one of the things that's a little bit different about our secondary markets team versus the primary team is, you know, we really do work across asset classes, you know, where I think Marcus and Millichap is known in DFW for really mostly B and C class. You know, we work on A class deals as well. In fact, if you see this one here behind me, you know, in the background, that's one I sold last year in Waco, A class deal, 2014 construction, you know, and really a pretty awesome asset. You know, and I think one of the other things that's kind of interesting about the secondary markets too, is that you can find some A-class deals that are ultimately really value add that I think that's a lot harder to do in a primary market like DFW. So, you know, here you can see a few deals we've done recently over the course of the last few months, closed deals in New Mexico and Texas, in Oklahoma. We've done some work out in Louisiana as well, and we're starting to focus a little more. We've got somebody working hard on Arkansas. So, you know, definitely trying to cover all the neighboring states pretty well. And once we've, you know, got Texas and the neighboring states covered, well, then we can move on to Philadelphia and the other markets that Paul likes.
That's perfect. If you want to jump over, I think the first one we're going to cover is Waco.
Yeah, so Waco is really one of my favorite secondary markets in Texas. There's a lot of reasons that I like it. I would say one is excellent population growth. You can see there grew by about 10,000 residents last year. I think that works out to nearly 4%. So extremely fast growth. In fact, if I'm not mistaken, that would make it the second fastest growing city in Texas behind Austin. So to the question earlier, do we see, big growth in any of these secondary markets? I think the answer is yes. As a percentage, Waco grew a little bit faster than DFW did last year. Average increase, really high, shows a strong economy there. At about 5%, that's a fantastic number. But not only do you have great wage growth, you have a very diversified economy in Waco. And so I think that's another huge advantage. I would say, probably a lot of the investors out there have heard about Waco because of the show Fixer Upper, because of Chip and Joanna Gaines, and Magnolia Market. Certainly that has become a huge attraction for Waco. And in fact, my understanding is that for folks vacationing alone, Waco is the number 2 vacation destination in America, just behind Hawaii, which seems crazy to me. Why would we be comparing Waco, Texas, and Hawaii? But that's why. So tourism is certainly big there. But you can see that list of industries, all very strong. Education, over 30,000 students in the market, but spread across a variety of schools. TSTC, I think, being kind of a hidden gem, it shares its campus with L3 Harris, which you can see down there in the aerospace and defense category. So it is a shorter term college, just 2 years, but most of the people who attend that college are not necessarily just local Waco residents. They are moving there to go to that college to get a specialized degree that will help them move directly into the aerospace and defense industry. Logistics is huge. Amazon just announced there with Governor Abbott that they're opening a major new facility. They're now going to match Walmart in terms of employment in the area. And actually Army and Air Force use it as a pretty major logistics facility as well. Healthcare, got some great options there. Advanced manufacturing is a big deal. Waco's a market where you can find a lot of highly educated people who are able to take on those jobs, but still have a low cost of living. So ultimately can do it at a pretty low total basis. So that's one of the reasons that's taken off. We talked about tourism and aerospace and defense. I think it's pretty interesting too. SpaceX has their facility in McGregor. Pretty much all their employees live in Waco, and that facility is where they've developed the Falcon heavy rockets, among others. So, that work is being done there. Also, interestingly, L3 Harris, another project I saw in the news recently, they actually developed the specialized Boeing plane that is now used by Virgin Galactic for their space launches. So, Waco is really carving out a nice niche there. And one other just, interesting win, apparently one of the largest manufacturers of tile grout in the world, Usen Utz, a German company, is now opening their largest U.S. facility there. That's where they're going to handle all training. There's going to be over 1,000 people there. So again, just another great thing that's happening in Waco.
All right. Let me see. I think, Matt, did you have a couple slides here, I think, on Beaumont, and then we'll get to some of the deals on the market.
Sure. So first off, Beaumont, very excited to have a few deals that'll hit the market here shortly. But Beaumont, if you don't know, it's in Southeast Texas, 84 miles east of Houston, and just north of Port Arthur. There's just a tremendous business climate in that particular area. Particularly, wanted to point out the the Port of Beaumont. So it's very active, and kind of when it's if you include the Port Arthur, Orange, and Port of Beaumont, it's called the Golden Triangle. And that's responsible for tremendous trade, and especially with a lot of countries as well. So just really strong economy from that standpoint. Population in Jefferson County, Beaumont MSA is over 255,000. Median age 35. Median household income 48,000 plus. One thing I'd like to mention is just the population growth. It's nothing major, but about a 1.3% year over year. So just a super steady market as well. I did want to point out just a few other economic drivers here. So obviously your hospitals, there's several that are there as well. Beaumont is also in downtown Beaumont. Their cultural arts district is it's booming. There's actually 6 current museums that are in downtown Beaumont, and in fact, there's been a project approved for over $17 million. The first portion of that 5.9 was just funded, and so it's continuing to grow. It's also creating a lot of jobs as well. Obviously, being in that Southeast Texas, ExxonMobil, a few other employers as well. Lamar University is probably another staple as well. So pretty diverse economic drivers for Beaumont.
All right. Maybe touch on some deals that you guys have either have on your contract or coming out on the market here in these markets.
Matt, you want to hit on Century Tree and Aspens first?
Yeah. So these 2 deals, it's a portfolio, 50 units combined. We've had them on the market for about a month or so. We launched at early December, so holidays kind of slowed us down a little bit, but yeah, still on the market. We're accepting offers as they come. So we're whispering low 2 millions, but happy to discuss further. Also, you can download the marketing packages for any of these deals and any of our current listings on multifamilyadvisors.com.
All right.
Yep. Thanks. And yeah, the Madison, another great property we got on the market right now. So that one's in Waco, right in the downtown area. Really, really cool property. Really an A-class property. Built originally in 1923, totally rebuilt in 2019. So entirely new steel support structure, all new electrical, plumbing, windows, doors, unit interiors, et cetera. One of the things I mentioned earlier is that you can actually find a real value add deal in even an A-class deal in some of these secondary markets. And so, I look at this one. This is one where really their 1-bed, 1-bath rents in particular are well below market. And so, basically there's a ton of loss to lease to burn off. So I think there's some great upside through management on this deal. So really fantastic property and good looking property, New York style. We've got a couple of properties as you can see down below under contract right now in Waco. Those should be closing here in the next 2 to 3 weeks, both of them, another in Lubbock. And then you can see off to the right, several properties coming to market soon. A couple in Amarillo, the one in Pampa, that's a little bit northeast of Amarillo, and so on. And then also we've got some land that I think is ripe for development that's on the market as well. They're in Crescent, which is a little southwest of Fort Worth, as well as in Sherman, up north of Dallas.
All right. So now it is time for the quick fire round for you guys. So John Floor asked, how have cap rates changed and what's your forward looking view on cap rates?
Yeah, I would say, cap rates in the secondary markets have probably compressed at least at the rate that they have in the primary markets. I would echo what Bart said earlier about the, spread that we typically see. I think that remains true, but I think that, taking that forward-looking view, we're expecting cap rates to compress a little further, especially as interest rates have dropped and those rates seem to be staying low. And so I think secondary markets are going to lag the primaries just a little bit. But I think forward looking, yeah, we're going to see the cap rates actually move further down.
All right. Ravi asked, what factors make a secondary market a good one for multifamily? Matt?
Yeah, I'll jump in, for this. I think, I think we've mentioned this at least several times in different ways on this call, but, definitely looking for the good economic drivers. You definitely want to, each deal is going to be just a little bit different as well. Take one, for example, Sweetwater, Texas. It's west of Abilene. And Abilene is about a 2.5-hour drive west of Dallas, right? And so I was looking at a 22-unit deal there. And so Sweetwater, it is absolutely a tertiary market, maybe under, 8,000, population. But on this particular deal, it was, 80s product, had not been renovated. And basically there was just, they got it at a really low price point per door, probably low 30s. And, on the back end, just saw it sold, for high 60s a door. And so I would say, definitely look at the opportunity for each deal. But in regards to the factors, it's definitely good to look at the economic drivers. Yeah.
All right. Michael asked, why do you think secondary is better than primary? Sean?
Yeah, I mean, I'd love to say it's just because of the amazing brokers. I don't think that's entirely it. What I like about the secondary markets, going back to what Lane and others said, is I think you have an opportunity for better yields, especially day one. But at the same time, I think, and again, to echo what Bart and others have said, this is Texas. Texas is as a whole, a fantastic place to invest. And so I think you're also going to get the kind of appreciation that much of the country can only dream of. And so it's really a pretty killer combo that I just don't think you see in a primary market.
All right. So Paul asks, what are common mistakes investors who are used to primary markets make when moving to secondary markets?
So I'll jump on this one. I think the biggest mistake would probably be with management. And there's a deal that we've been working last year. It happens to be in Nacogdoches, and this particular ownership group has historically been in primary markets, but they found an opportunity in Nacogdoches. They came in, and in the last 2 years of ownership, I mean, they've switched management companies 3 times, and they're finally with good management. I feel like they finally got good boots on the ground to where here in the last 8 months through COVID, they were struggling to be at 75% occupancy, but now they're finally at 95%. So I would probably say that's the number one mistake.
All right. Prashant asks, I think we've hit on COVID.
Yeah.
Maybe talk about sort of first half. I guess the deal flow looks pretty good. So maybe talk about this last one, or number 7. Steve asks, cap rates, and then I guess how are buyers underwriting sort of exit caps in secondary markets? On primary markets, you might do 50 basis points over 5 years. Are you seeing people sort of use a larger gap in exit cap rates? What are you seeing?
Yeah, I would say probably most commonly it's 75 to 100 basis points is what they're assuming on the exit caps. Again, I touched on it earlier, but my expectation is we are going to see cap rates drop in the secondary markets. I think again, we're seeing DFW. I've heard of the A-class deals in DFW occasionally trading under a 4. Now I've heard of the first couple B-class, that have traded at sub 4 caps. And so I think as we see those DFW and possibly even Austin, Houston, cap rates dropping, that we're going to see the same thing come in these secondary and tertiary markets. So yes, underwriting a change there and probably a little bit bigger one, but I think that's what the future holds.
All right. Well, I appreciate you guys jumping on. If you guys can hang out for a little